as far as the Ind AS 103's framework is concerned, is talking about the business combinations, where we talk about the acquisition of a business, right? That's where the word business combination originates from. All right. So when you look at this entire gamut, and that's something which is what we want to discuss in the overall structuring of this entire standard, is we talk about Ind AS 103, where we cover business combinations, where it defines what is the meaning of a business and a business combination, right? And then we move ahead where we talk about, of course, the acquisition method, where we discuss in terms of what are the steps involved, right? How do you demonstrate that a business acquisition or a business combination has taken place, where we talk about steps including identification of acquirer, determining the acquisition date, and then the purchase consideration and the subsets involved in that, right? And importantly, this is the same sequence that we intend to follow even when we are doing the consolidation questions, right? So we would be doing this entire process under the same format, right? Just to ensure that we understand the entire flow and the stepwise calculations of each and every element there, right? So when you look at the purchase consideration, it would talk about multiple ways in which the purchase considerations are, let's say, made. So for example, if I'm saying a company X is acquiring company Y, and probably it is issuing shares in company X itself to the shareholders of company Y as a part of purchase consideration. Or maybe it is giving cash, or maybe it's giving a combination of shares and cash both, or it could be another ways of, let's say, meeting the obligations so that the business combination is achieved, right? So the thought process that is involved under the acquisition method is to identify and measure what are those assets of that other business which are acquired, and what are the liabilities of the other business which are assumed by the acquirer. Okay. And then basis that, you also want to calculate, right? Are you paying something more than what is the worth of the business, right? If yes, that would become a goodwill. Or if you are paying less than the worth of the business, although it is happening in very limited circumstances, but in case you're paying less than the company's worth, then it would result into a bargain purchase, or or with a negative goodwill that we want to kind of call it. There is a specific way we treat this. That's something that we want to talk about later, of course, when we deal with the respective section, right? Also, business combination also tries to address that to acquire a business, to have a business combination, it is not a mandatory that you acquire 100% stake in that other company. Okay, a business combination can very well be achieved with less than 100% stake in the other business, right? And that's where you start recognizing something called as a non-controlling interest. Okay, in our earlier academics, we have heard this term called as a minority interest, right? So it is just being considered. It's now being mentioned as, or called upon as, a NCI, or a non-controlling interest. So there's a discussion around that area as well when you look at all these aspects under the second step of acquisition method, right? And then you also want to highlight as a part of the discussions in terms of, what if you have acquired a business in which, let's say, there are some reacquired rights, there are some contingent liabilities in place, or if there are instances like indemnifications, and also the subsequent accounting of a contingent consideration, right? So while contingent consideration could be a part of purchase consideration, the argument lies that how do you deal with subsequently as far as the value of that contingent consideration is concerned? Okay, so this is something which is a broader overview around which we want to kind of bring this along. And then there are also discussions around common control transactions. If there are two entities falling within the same group, and then there are transactions happening in place within those entities, then how do you deal with that part is something which is a discussion to be followed by the disclosures there. Okay. Importantly, what we say, when you look at a business combination, right, the whole idea is that where the acquirer, and that's where we want to kind of spend some time eventually, obtains control over one or more businesses. Okay. Here, my focus or our focus would not be about understanding what is control. That is something which is covered by Ind AS 110. Okay. But the focus would be on the term business, right? And the business word is very clearly defined. The term business is defined very clearly as an integrated set of activities and assets capable of being conducted and managed to provide for goods or services to customers, generating income or generating investment income or other income from ordinary activities. I don't expect, again, we should be knowing this entire definition by word, but what is critical is to be able to analyze whether an acquisition is that of a business versus that of an asset, is something which is the crux of this entire discussion that we are going to do. All right. So again, if I look at the word business combination, we achieve a business combination when we are actually acquiring a business. All right. So in a very generic way, in a very generic manner, or in a very layman's term, if I were to understand the meaning of business, what do you think it comes to your mind when you look at the word business? What is the business all about? Okay. Are we saying that an entity has to necessarily sell something? Does it have to necessarily be producing something or providing services, right? Does it have to have some physical assets or licenses or people or, let's say investment in some, funds, etc.? Or is there a way that we can distinguish or clearly identify a business? Is something that we briefly want to talk about. Okay. The key element that you want to pick up from this entire definition is a business is basically an integrated set of activities, okay, and assets capable, this is again important, capable of being conducted and managed to provide for goods or services. Okay. It does not anywhere state within the definition that it is providing goods or services, right? It is not the expectation, to be very honest, right? What is important is that there are integrated set of activities and assets which are capable of building that eventually. Today, you might be conducting some research activities. Today, you might be only having people with you who are working towards a particular objective, but then it's all an expense. You haven't built anything on your own. You're still trying to do that. Okay. And that's pretty much common in some industries. For example, if I were to look at, let's say, a pharmaceutical industry where a significant time is spent purely on the research front. Okay. Right. So when you look at an acquisition of a running set of activities, right, would it meet the definition of a business is the entire conversation that we are trying to build as far as this point is concerned, right? So what is a business all about? We say a business would be comprising of, importantly, inputs, process, and output. Okay. For example, if I say I'm looking at my investment in assets, my IPs, intellectual properties, right? My people, right? My investments in general, right? It could be physical assets also, it could be monetary assets also, it could be anything for that matter. And at the same time, I would have operational processes or resource management processes or strategic management processes which are aligned with those inputs, right? So in a way, I'm utilizing those inputs as a part of my operations, as a part of my decision making, as a part of my execution. Okay. And then I normally expect that both those inputs and processes will be also generating goods or services for the customers, right? Eventually, creating an investment income or revenue or let's say income from ordinary activities. Okay. But as far as this standard is concerned, as far as the definition of business from Ind AS 103's perspective is concerned, output is not mandatory. It is not necessary to have output to be able to call it a business, right? However, both input and process have to be present to be called as, let's say, a business. Okay. Now, why do we need this information, right? While we'll be discussing very importantly also about whether in some instances would you want to call it something as a business or it would be, let's say, an acquisition of an asset, right? Why this distinction is required is something that we want to talk about briefly. Let's try and understand that. If I'm saying that there is a company X, okay, and there is a company Y, all right. It has, for example, a building, let's say, which is available in the form of a laboratory. So it could be, for example, let's say, a pathology lab, all right. But then if it were that laboratory, we are saying that there are all instruments in place, okay, there are all tools in place, and that laboratory is fully furnished, for example, right? However, there are no employees yet appointed. There is no, for example, facility to do any bookings or let's say reservations to get some tests done, etc. Right. So just a hypothetical scenario that we are trying to build here. Right. Now, we say that company X acquired, for example, 100% shares in company Y by payment of let's say rupees 10 crores. Okay. And say for the sake of argument, the value of all these items, the laboratory, the building, the instruments, tools, etc., the value thereof, for example, comes at rupees 9 crores. Okay. The simple question is, how do I, if I were company X, how is the accounting done for this acquisition? Right? How is the accounting done for this acquisition? should I actually, and before I answer that question, the first argument or the first important question that arises, is there an acquisition of a business or of a group of assets? It's a very important question. Is there necessarily, in the given case, an acquisition of a business taking place, or should I conclude that it is nothing else but a lot of assets and you are just paying a lump sum amount for all those assets together, right? What is your thought on that? Right? We need to assess. We need to assess every such acquisition, every such case from the perspective of an input and processes context. Output is not necessary. It may be there, but it is not necessary. So we'll probably exclude it from our conversation. Okay. So when I talk about the input and the process, we try to establish whether both the processes as well as the inputs exist as far as company Y is concerned, right? Do not, importantly, very, very importantly, do not get carried away by the fact that you are acquiring a company because it's a company Y. You are acquiring shares in a company. And if it is a company, it is a business. No, we do not want you to consider that. We cannot assume it like that. Okay. What we are saying is that you are buying stake in that company. You are acquiring 100% shares in that company. For what? Is it towards a business or is it towards an asset or a group of assets? Okay. And that's the reason why it is critical to assess whether there are both present, the input as well as the process. Are these both present or not is the question. Okay. Now, clearly in this given scenario, my input is present. I have the laboratory, I have the instruments, I have the tools. So everything that is there, which has a capability to generate future benefits, is very much there. So yes, the input is available. However, the moment I see that the process or processes are concerned, there is no manpower here, although we can still argue that it's a part of an input, right? But even for that matter, there is no facility available in that laboratory. You know, the structure exists, but there is no way we see that the facility to book the tests or be able to use that facility. There is no such provisioning available. All right. So if this process is missing, then automatically the output is missing as well, right? But any which ways, we may not be really concerned about, the term output, for example. But essentially, while the input exists, but the process is missing, right? We cannot name it as an acquisition of a business, but we would want to refer this to as a acquisition, or we want to refer this to as an acquisition of an asset, or in our example, it's a group of assets. Now, what would that imply? That would simply imply that I'm paying 10 crore rupees towards acquisition of an asset. So accordingly, my accounting would be driven by Ind AS 16, right? Which is property, plant, and equipment. Ind AS 103 is not at all attracted as far as this conversation is concerned. Okay, or this acquisition is concerned, Ind AS 103 is not attracted here, merely because of the fact that the word process is missing. Okay. On the other hand, and I think it's an important point to highlight here, if the facility was operational, the systems were in place, okay, the laboratory had all the facilities where it actually could allow people to do the billing and have the facilities wherein people could actually come and, for example, let's say, book those tests, etc. Right? In that context, both input and process would have been met very comfortably. Okay, and in that scenario, my accounting would have been attracted or would have been covered under Ind AS 103, right? And then we say under Ind AS 103, we would say, well, we are acquiring assets worth 9 crores. We are paying a premium by paying 10 crore rupees. So let's credit bank here 10 crore rupees. And the differential amount would have been the premium, which is referred to as goodwill. That is the key difference between identifying whether you are acquiring a business or are you acquiring an asset. The moment it is a business combination, the moment it's an acquisition of a business, Ind AS 103 is attracted. However, if it were an acquisition of an asset, very likely, either Ind AS 16 would come in picture, or Ind AS 38, which is intangible assets, would come into picture, or Ind AS 40, which is investment property, that will come into the accounting scenario. So that's a fundamental difference that we need to know at any point in time when we deal with the scenario, right? Your examination can very, very comfortably give you such kind of scenarios, and you should be well aware of it, whether the acquisition is necessarily of a business or not, right? As we said, the reason why we want to know these things, because there is a considerable difference between accounting for a business combination versus accounting for an acquisition of an asset. Okay. Clearly, under a business combination, you will see most of the times a goodwill, a positive goodwill or a negative goodwill. There is a bargain purchase that come into existence, right? Under an asset acquisition, there is no such thing called as a goodwill. What you pay towards an asset becomes the cost of that asset. Remember Ind AS 16, purchase price, that's the cost, right? Also, importantly, we'll be discussing that at length. When you acquire a business, you measure those assets and liabilities that you acquire at their respective fair value. Okay, I would want you to recollect the conversation that we did in case of Ind AS 12, where we talked about that goodwill exception, right? The fair value aspects of identifiable assets and liabilities was discussed there briefly. Okay. However, if it were an asset allocation, then you would simply allocate the cost. Again, Ind AS 16, Ind AS 38 or 40 would come into the picture. Okay. Now, on the third part, where you look at the directly attributable transaction cost, I would rather want you to take to the Ind AS 16 and Ind AS 38 framework, where we said that any directly attributable costs are added to the cost of that asset. Okay, but the moment it's a business combination, this is taken towards the statement of profit or loss. It's a clear expenditure. Okay. The next step, of course, it could be a very specific aspect under the business combinations, We'll be dealing with that separately, but this is also covered briefly under Ind AS 12, where we said that any deferred tax consequences on initial recognition are recognized under the business combinations, which is not the case on a day one recognition, right? So this is an exception under Ind AS 12 criteria of deferred tax recognitions there. And finally, since we are acquiring a business, naturally the details of the disclosures are going to be fairly extensive. It's a more inclusive information that need to provide. It is not a single entity anymore. There is more than one entity under a business combination. So the disclosures are quite detailed as compared to an acquisition of an asset where the disclosures are relatively lesser. Okay, that is something that you want to pick up as a part of understanding why we should be knowing whether we are acquiring a business versus acquiring an asset. All right, I'll briefly talk about this part specifically. I think I wanted to highlight that the initial measurement of assets acquired and liabilities assumed is done at fair value under a business combination versus an asset acquisition, which is the cost is allocated. Okay, say for example, there is a company X which is acquiring 100% shares in company Y. Okay, now company Y is, let's say, a business, for example. Okay, in the books of company Y, there is an asset 1 and let's say asset 2 with a carrying value of 1,000 and let's say 2,000 respectively. So let's say, for the sake of a number, the total assets in terms of the book value, company Y is worth is 3,000. And just to match the balance sheet total, we're saying the other side only as an equity, there's no liability. That is also amounting to 3,000 rupees. Okay. Now, let us say the fair value of these two assets. Okay. This is 3,500 and this is 8,000, which makes it, of course, 11,500. All right. Now, the argument is very simple, very straightforward, is that if company X wants to acquire the business of company Y, it's a running business, it wants to acquire the shares in company Y so that it can acquire the business of company Y. What is the real value of X? What is the real value of Y, the company Y, that X has to understand? Is it really going to go to the shareholders of company Y and tell them, look, your company's worth as per the books is 3,000, so I think I can pay you 5,000 also? How do you see that? Now that would be absolutely a theoretical value. It does not make any difference. Company Y's real worth is 11,500. Okay, the true worth of the business is 11,500, and against that, that becomes a benchmark value against which company X has to offer probably a better pricing, and that's the only reason why the shareholders in company Y will be interested to sell their stake, as far as the company Y is concerned. So for the sake of a number again, if I say that company X offers, let's say, 15,000 to acquire 100% shares in company Y. Okay, so company X offers 15,000 rupees to acquire 100% shares in company Y. Since it's a business acquisition, since it's a business combination, right? You're acquiring a business. So we are saying that the consideration or the purchase consideration is 15,000, right? But the value of the business, right? The net value of the assets, the true value is of course 11,500. That gives the balancing amount as goodwill to the extent of 3,500. So this 3,500 would be recognized as a separate item, in the group financial statements. Okay. As far as the company X group is concerned, this goodwill is something which is a kind of a future benefit available. It's expected to arise because you're paying 15,000 for something worth 11,500. You are certainly expecting some benefits out of that. That's the reason why you're paying probably extra. So this becomes a separate intangible asset in the group financial statements of company X, right? When would we do it? When it's a business combination or acquisition of a business, right? Intentionally, we have ignored the taxes here. Otherwise, the other exemption or the other calculations would have been also relevant. So just for the sake of simplicity, we are ignoring taxes here. Okay. But now, if I say that in the same scenario, the value of the assets are 1,000 and 2,000, but the fair values are 3,500 and 8,000. Okay. If it were an acquisition of an asset, right, you're paying 15,000 and there is an asset 1 and asset 2, which are 3,500 and 8,000 respectively. That of course makes 11,500. This 15,000 would be allocated on the basis of the respective fair values of these assets. Okay. When it is an acquisition of an asset and not a business. Okay. This entire 15,000 will be allocated respectively to asset 1 and asset 2 in proportion of their fair values. Okay. That means this will be 15,000 into 3,500 divided by 11,500, and this would be 15,000 into 8,000 divided by 11,500. Let's do a quick calculation there and see what are these values. This gives me the value of roughly 4,565, and this becomes 10,435. Right? Now, the moment I see these two values, how should company X be recognizing these two assets in its books? We are saying debit asset 1 at 4,565, debit asset 2, which is 10,435, and credit bank 15,000. Now you would see there's a significant difference between the accounting under a business combination versus accounting under an asset acquisition. Okay. In the previous case, we said asset 1, we take 3,500, asset 2, 8,000, goodwill, which is 3,500, and we said credit bank 15,000, right? This is the business combination, and this is of course acquisition of asset, or in our case, of course, it's a group of assets, something that we need to be very, very comfortably knowing here. Okay, something that you really want to pick up from this conversation standpoint. All right, thank you very much.